Hello, everybody. This is Prince Pierre, your FPI. Yes, right, financial professional illustrator. Coming back at you with another stomp down. Understanding life insurance. Why do we need it? Why do we need it? Right? Yeah, why do we need it? Well, we're going to let y'all know what's going on why we need it. We're going to bring this information right directly to you on why we need it, right? A lot of reasons why we need life insurance. You know, to bless our loved ones when we're no longer here. But what we're gonna do is break it down to you step by step. So basically gonna give you a quick lesson in life insurance to let y'all know what's really going on, right? So you're going to get directly into it, and let's go. First thing you need to know about life insurance is all about pretty much protecting your family and ensuring that your family will have the same earning power that you have while you was alive when you're gone. Here's an example of earning power, right? Excuse me. So, if you make $50,000 a year, you will see that 5, 10, 15, 20, all the way to 40 years, right? So you make $50,000 a year. We just do the realistically of 30 years. That means you would have made 1.5. If you're 100,000, you make 3 million. If you're 250,000 a year in there, you would make 7.5 million. If you make 500,000, you at least make what? 15 million, right? Now, you have to understand where you lie in this scale, wherever you is. If you in between 50 and 100,000, or you in between 100 and 250,000, or you in between 250,000 and 500,000, right? What is this telling you? Well, it's basically telling you if you was to purchase life insurance, that you're trying to pretty much ensure that this earning power is insured through your premiums that you pay wherever you line up at. You say, okay, I'm 45 years old and I'm 45 years old and I make 250,000 a year. Well, you're gonna make $5 million, right, in the next 20 years if you're 250,000 there. So that means you probably want you to get you a life insurance policy that's at least $5 million for the next generation of the next 20 years. See, this is assuring that your family will have your earning power, your average salary per year over the time that you want. So for the next generation, you would have insured your family $5 million if you were 250,000 there per year. If you 100,000, that's 2 million, and you 50,000, that's $1 million. So, and 500,000 or more, it'd be 10 million, right? So that's what kind of insurance you would buy, right? So, how much insurance would you need? Well, it's going to have to cover your final expenses. It's going to have to replace all or portion of your income. Keep your family in your home. Establish a college education fund if need be. Cover financial emergencies and provide child care or home health care fund. Right? What type of insurance should you buy? Should you buy term or should you buy cash value? You would buy a term life insurance if you know you figure like you're not going to live for another 10 years or 20 years or 30. Okay? That's 10-year term. That's the least you can buy. 20-year term. And the maximum you can buy for 30-year term, right? You also have cash value life insurances. And those insurances would be whole life, and index universal life insurance policies, right? Then the ones that give you cash value. And what cash value do is pretty much a kitty or a bank account that you can pretty much withdraw money from if you need during your lifetime. And it also is whole life, so your death benefit will either stay the same, or you can also increase your death benefit if you choose to be, right? Now, types of term that would you like? Would you like a renewable life insurance features, or you want a decreased term life insurance feature? Okay. Level death benefit, increasing premiums if renewed. No cash values though, that's the disadvantage. May pay policy dividends if it's a participating carrier or provider of the insurance, okay, in that term. Also renewable, but may be subject to medical qualifications and best suited for level temporary needs. Then you also have what you call decreasing. These are decreasing if it's based getting its premium best off your house. This would be return of premium. This is what you would do an ROP, return of premium term, because it's based upon your home. So it's decreasing benefit, death benefit, level premium, no cash values. Along with if it's a participating carrier or provider, you could get policy dividends and best suited for decreasing needs that ultimately disappear, like your home go down, whatever, every time you pay it, things like that. And then the term advantages is it's a low initial premium. It means you pretty much can get, you got a certain carriers that I work with that on term, pretty much if you're under the age of 50, you can get pretty much a low premium. You can get 5 million, 10 million, 1 million to 10 million term insurance for about $50 to $120 a month, in between that range, right? It depends on whatever. And it's well tuned for short-term temporary needs. And most plans can be renewed if you are medically qualified. That means you can renew it, or you can also transfer it or convert it into a whole life or IUL or whatever you want to down the line before the term ends. Usually we get a notice 2 years before the term ends. I will notify you and say, hey, term in the end, boom, boom, boom. You want to convert this, to a whole or a UIL. If you got a return of premium, boom. That means you wouldn't worry about it. You just get all the premiums you pay back to you, and you'll be able to go start pretty much whole life or whatever you want to put in. Okay, if you want to do it that way. And then the disadvantages is that the premiums in future years may become expensive. Insurance protection may cease before death. Yes, if the insurance is gone. And it does not be a cash value. Right? Now you got a level term. What is a level term? Level term is very important, which is a life benefit, level death benefit, level premiums for duration for a period of 10 to 20 years, increasing premiums if renewed after select time, no cash values, dividends if it's participating. Return of premium. Return of premium insurance enables you to hedge your bets. If something does happen to you, you're provided for your loved ones. If you outlive the policy, the premiums you have paid will be returned to you. That's the key to a return of premium feature in term life insurance policy, right? Is if you buy that. Now you got different variants of whole life insurance. What is whole life insurance? You got whole life, you got universal life, you got index universal life. So you got 3 of them, right? So whole life is pretty much pays the pays a fixed level premium and cash values accumulate at a guaranteed rate of return. The insurance company promises to pay a guaranteed death benefit. So it means you get a whole life, whatever you initially illustrated and you agree to the illustration, or whatever your death benefit is, basically it will be guaranteed with that death benefit from $100,000, $200,000, $250 all the way up to 10, 20, million, whatever you ask, whatever you willing to pretty much qualify for, or you're willing to accept on that initial illustration of policy contract. All right, then you also have universal life insurance. The policy owner can increase or decrease premium payments and select from a level of increasing death benefits. Here's when your death benefit can increase when you get into this part. Because that means you can come back and say, I want more. You can come back to me and say, I want more death benefit. Because your earning power done went up. So you went from a 250,000 there to a 500,000 there. You're not going backwards or on up. So now you want to increase your death benefit because your earning power has increased. Okay. Next thing, index universal life insurance. Okay. The policy owner can increase or decrease premium payments and selected forms a level of increasing death benefit. Cash value accumulations reflect the performance of the stock market index. Now, this is going to explain to you. This pretty much guarantees the subject of claim paying ability of the insurance company. What this means? It pretty much is going to have a cap, and it's also going to have a floor. All right. So you're guaranteed not to lose any money in the index, but you're guaranteed to make a little money off the interest rate of it. So, yeah. So when you do that, you are the best in S&P 500 index. They will take it, they'll allocate usually 3% up to 6%. Depends on the policy or whatever carrier that I choose that fits your needs. I will send you over there and get you the best deal, get you the best possible, play that you want when it comes to this index universal life. And it is guaranteed to rise and never guaranteed to decrease. Okay. You have other ones like variable index life insurance, universal life insurance. And those are big risk. Those are more risky. But as we do here, we just give you the information to happen. And then, like you say, whole life, pretty much guaranteed, like we said, universal, pretty much you can increase the death benefit option if you want to, okay? And then also you can decrease too if you want to, the death benefit also. So that's what you do in these universal life. And then pretty much index universal life, okay, is adjusted upward or downward on your premiums, choice or level or increase in death benefit on. You can increase it. Also, you can it'll play the S&P 500 index. You understand me? So you pretty much this is probably the best insurance you would want to have is an index universal life insurance policy, because you'd be able to pretty much safely play S&P 500 market. Okay, like Wall Street Trapper got you over there bullshitting. Well, let's get you an index universal life insurance policy, man, and you pretty much can be safe enough to increase your value of it. And you got other products we also talk about. But this is all about understanding life insurance. See, the advantages of it is lifetime insurance protection, premium and death benefits. Cash value growth has the potential to be higher interest rates when the equity markets are strong, while still earning a guaranteed minimum interest rate during downturns in equity markets. So you're guaranteed to win. You will not lose in an index universal life insurance policy. Your cash value will grow, okay, based off the interest rates that particular carrier had, okay. They do have caps, so you're not going to fluctuate to no 15-20%, but you will not go below most likely 3 to 4%. A lot of times it's 4%. You understand me? 3 to 4. That's what we'll say right there on majority of the carriers I deal with, right? That I work with. All right. Index universal life insurance disadvantages. Required premiums may increase as insured gets older in order to maintain needed insurance protection. Yeah, it could increase down the line. It could, but a lot of times, it's going to be rough. It's a hole, so usually all fixed. But it could increase if something happened Cash value growth may be disappointing due to the downturn in the equity markets. What that means is you won't lose, but you might not gain like you probably would. Okay. Now we also have survivor insurance. This here is for if you're married. Okay. And this is to protect your estate, right? This is pretty much a state protection of estate insurance. And this insurance is pretty much based off the federal state tax. If you get this type of insurance, you kind of will not have to pay a federal estate tax, if the first spouse dies. Okay. It doesn't mean, however, that the federal estate tax is eliminated. Instead, potentially, estate tax liability is postponed until the second spouse's tax. Now, so the way you can whoop that is going to get you an invocable life insurance trust. That's how you whoop that shit. Okay, so that means like your second wife, you need to have insurance trust and go to the beneficiaries, which whoever it is, your children, whoever. That's how you can beat that. Okay. Then you have special needs challenge, special needs planning. So if you have a child with special needs or whatever, you can set them up on the survival plan. And then charity gift. Okay, if the second spouse comes, you can pretty much have money go to a charitable organization you want to give to, and you be good to go. Now, in situations like these, not knowing which one will die first, husband and the wife could each purchase a separate life insurance policy. A better solution, however, might be a survivor life insurance policy, also known as second to die survivor insurance. Survivor life insurance is one policy that insures the lives of two people, usually a husband and wife. No death benefit is paid when the first insured dies. Instead, the policy remains in effect and premiums continue to be paid after the death of the second when the death beneficiary goes to the paid beneficiary. So that's kind of the disadvantages of survivor insurance. Okay. And usually a lot of times, it depends. If you're dead, both of you got to go for a benefit, for a death benefit pays out. Okay. I would advise you to get a separate life insurance policy for your wife, separate insurance policy for the husband. That's what I would advise you to do. Why? This makes more sense. You understand me? That death benefit can go in there. You can put it in a trust. You can do a lot of kind of different plays with that. But if you want to do survivor, it's still decent insurance you could get. But I would advise you to get separate insurance policies and make your wife make you the beneficiary, and then if when she got her insurance and you the husband, boom, make your wife the beneficiary. Okay. Now, before we close out, we had to show you, the tax code, man. It's all about tax gain, okay? While we get insurance right now, understand, I'm going to break this down to you. So, premiums generally paid for insurance, okay? If the individual couple are not tax deductible, okay? In case of a return of premium, any premiums returned by the insurance company are received tax-free by the policyholder. So, yeah, because pretty much this is all after tax. After tax, your individual, it's going to be after tax. Okay. So, if you are in a corporation or working for somebody, they'll call that before tax. Okay. Most of the time. Okay. Now, you got life benefits. You got cash value. Let's talk about the cash value on the tax gain. Cash value accumulations and cash value life insurance growth at a tax-free basis until the policy surrender. Yeah, you have to surrender the policy, okay, to get a 10% surrender penalty and sometimes 15 to 25% federal income tax. Before I hit you with the capital gains on your bitch ass, you understand me? But if you borrow money from your cash value, you will not be taxed, okay? Policy dividends. Okay, I probably jumped over stuff a little bit, but we'll touch back on that. Policy dividends. If a policy pays dividends, the dividends is considered a return of premium, so it's not taxable. Here's the point blank. Okay, participating carrier, right? Okay, then you got policy loans and withdrawals. Okay, a policy loan is not considered a distribution, and as a result, is not taxable. That's how I stated. However, there are an outstanding loan when the policy lapses or is cash surrendered. Okay, the amount of the outstanding loan is taxable. So if you borrow somebody and you're not taking care of your business on your premiums, and you let the damn insurance lapse or anything, then the IRS will be coming to holler at your motherfucking ass. That's right. As long as you take care of your business and you have what you call credibility, okay, that means you pay your bills and you take care of your business, you won't have any problems. Okay. And I think the end of this, the death benefit, is what we need to really look at. Is income tax personally owned insurance. This is life insurance death benefits paid in a lump sum or receive income tax free, a unique and important benefit. So basically, death benefit will not be taxed. Okay, if death benefit is taken as income under the seller option, if there's an interest element in the payment, each payment received, the portion of the payment received in principal is received income tax free, and portion representing interest is taxable. So that means in the IUL insurance, if you got that benefit of say $5 million, okay, but over that period of time, you might have doubled, or you might have doubled it, right? Because of how much money you put in there. And say you made 1.5 million in interest. So now the doggone whole thing is 6.5. You're gonna get taxed on the 1.5, which was the interest that accrued over that life insurance policy. That's what you would pay. 5 million to be free and clear to you, but that 1.5 will be taxed. Okay, probably at a 15% or whatever, real low, probably about that much, or they might hit you with a capital gains on top of that. So it depends on how you play it. It depends on how you diversify that particular interest money, how you move it around to be able to get the lowest tax liability that you can find. Okay, and that's for stomp down, real enrolled tax consultants. Okay, that's who you got to deal with. I'm not one of them, but I'm just telling you, if they ain't enrolled with the IRS and they don't know, and hey, they don't know what they're doing. Okay, get certified, qualified people. Now, you got other benefits like waiver of premium benefit. You also have accelerated death benefit. Let's read the accelerated death benefit. Many insurance companies make it possible for policyholders to collect all a portion of a policy's death benefit early. If the policyholder is terminally stricken with a specific catastrophic illness or receives long-term care. Then also, these are pretty much called riders. Okay, and you have accidental death benefit of a small initial premium. The insurance company will pay an additional death benefit in the event of the insurer's accidental death. Okay, options to purchase additional insurance. Okay, for a small, in a return for a small extra premium, the option to purchase additional insurance guarantees the right to purchase additional insurance on the insurer's life at specific future dates, regardless of the future insurer's health or occupation at that time. So pretty much if you need more insurance, you can get some more. Okay. A lot of these insurance companies are liberal when you won't get more. Okay. And you have life insurance LTC hybrid plan. As a life insurance long-term health care, which known as a hybrid plan, complies with the benefits of life insurance policy with the availability of long-term care benefits should you need them in the future. And that's pretty much it. And that is pretty much it. You know what I'm saying? That is the information that we put out here. Stomp Down with Prince Pierre. Understanding life insurance and why you need it. Most important thing about why you need it is to be able to ensure your earning power, you understand me, when you leave here. So your family, you understand me, don't have no destitute. You're not going on GoFundMe doing the suck ass shit that you niggas be doing. Okay. All right. I hate to say it like that, but I had to put it where the ghost can get it, so you can have outstanding over and understanding of life insurance and why you need it. Okay, if you're in the Texas area, man, I'm only licensed in Texas. You can definitely reach out to me via email at pfuncc@gmail.com. Now hit me up on that. Also on the link, I dropped the link at the Plan Well link. Hit that Plan Well link, fill that 3-minute financial survey out, and that automatically gives me contact with you immediately, and to be able to schedule you an illustrating consultation, because I am a financial professional illustrator, but we will pretty much break this down. Also, we'll send you information such as like that PDF, send that to you to really have a lot out and understanding of why you need life insurance to have full hedge your bet protection when your expiration date comes. Okay, but we all guarantee that expiration date, so let's not play around and let's be real. Let's be stomped down. Let's not tiptoe around. Let's stomp down with this insurance. And hey, because you ain't stomped down, man, that means you ain't got no foundation. If you ain't got no insurance, you ain't got no foundation. Okay, we use vernacular words to mean other things, but we're very clever with our vernacular over here. So just let y'all know, y'all continue to do what y'all do, man. Y'all continue to have y'all a good day. Y'all continue, y'all, man, to strive for prosperity and human experience every single day. And like, hey, I'm Prince Pierre. One thing I am, I'm Texas, and I'm Texas every day. You know what I'm saying? In every single way, baby. You know what I'm saying? Like the oxtail man would say, baby, pause. But hey, man, we're gonna make it do what it do. Y'all have a good day, and we out of here. Yes, indeed.